Your guidance for the year, $2.5 billion in terms of loan losses. Where will the majority of that pain come from? Good morning.
Yes, good morning. We booked $1.1 billion of impairments alongside our Q1 results this morning. And as you say, we've given an outlook for the full year of €2.5 billion. And that reflects possible impairments across our book. We're very largely exposed to the Netherlands. 80% of our business is in the Netherlands, where we have a big business in the small and medium-sized enterprise sector. We also have a global business, oil and gas, as you mentioned, shipping, trade, and commodity finance. So we're well diversified. So it's no particular sector, but we're cautious on the outlook given the circumstances, and we think it's helpful to give a guide of where we think the year will end up, around $2.5 billion. I think it's important to recognise how strong the bank is. Our capital position over 17% common equity tier 1. So our buffer is a little over 7% over capital regulatory requirements. So we're really quite comfortable from a balance sheet perspective going into the COVID situation.
Clifford, great to have you with us. Could you help us understand a little bit more then in terms of the COVID situation and that guidance that you've given on €2.5 billion in impairments for 2020? How much of that is actually impairments and write-downs, and how much is actually provisions as a result of COVID-19?
Well, that $2.5 billion is our outlook for the year. So, as you say, we've only booked $1.1 billion of that in Q1. Some of that relates to, losses we've experienced. We had two exceptional client situations in Q1. It's about $500 million. But the large part of the rest of $500 million or so, I would say, are upfront provisions in anticipation of losses from COVID-19. So we're doing the right thing. We're strengthening our balance sheet, taking provisions ahead of what we think will be a difficult outlook. I think that's common across banks. All banks are concerned about the outlook, but it looks like different banks take different approaches. We're very confident we're taking the right approach. It's based on our outlook for the Netherlands. The Netherlands is a buoyant economy. The government has very strong finances, so it's well placed to support businesses and employees during this difficult period. We've taken a view on the economy. We think in the Netherlands, the economy is going to contract this year and begin a recovery probably Q2 next year. And that's the basis for our outlook of $2.5 billion. But as I said, the bank remains very strong. We can absorb these anticipated impairments and support our clients through the challenges ahead.
Clifford, can you or will you answer in regards to Hin Leong? It's your second biggest creditor. They owe you $300 million, we understand, after HSBC. Is this part of your provisions? And if so, to what extent does Hin Leong feature in those numbers?
Yeah, as part of our $1.1 billion, we booked an impairment of around $200 million in connection with trade and commodity finance. You'd understand we won't comment on specific names or client situations, but it gives you a feel for the scale of our impairments and how we've reflected them in our profit for this quarter.
To develop that point then, Clifford, what can you tell us about ABN AMRO's oil portfolio? Are you accelerating a decrease of your oil loan portfolio?
We've been de-risking or reducing parts of our oil and gas portfolio for really some time, particularly in the offshore sector. So that's come down quite sharply over the last 2 years. We do still have a sizable oil and gas portfolio. It's around €6 billion, but that's a little over 1% of our overall exposure. So the bank is primarily Netherlands-based. It's well diversified. We have oil and gas exposure. We've de-risked that. We've taken provisions where relevant, and we have quite a diverse portfolio within that sector. It's important to recognise that while some players are exposed to today's oil and gas prices, many others are hedged for the future, so can ride out dips in share prices, in oil prices, and different parts of that sector are more resilient than others. So we're comfortable with our oil and gas portfolio at this stage. It is a modest part of the overall book.
You guide the market this morning in regards to cost cuts of over $5 billion. You say that you're on track to deliver that this year. I want to get a sense, is there going to be an acceleration, Clifford, as a result of the shock phase that we're in? And we're trying to evolve on a weekly basis about reopening. You say $5 billion. Is that the top of what you need to deliver, or will you have to accelerate cuts? Just a little bit more context around that for us.
Yeah. We've had cost efficiency programs in place for some time. We've guided to total cost of 5.1 billion, not cost cuts for this year. So it's 5.1 billion. As part of that, we are executing a cost efficiency program of a total of 1.1 billion, and we've delivered 950 million of that. So we're making progress on our cost efficiency programs to deliver our 5.1. We've reconfirmed our guidance of 5.1 billion. Now, we're seeing some cost benefits of the current situation. So when the business is in lockdown, you're going to spend less money on travel, on events, on marketing, for example. But we're also seeing some slowdown in our ability to execute our ongoing cost efficiency programs because everybody's at home serving clients. And so we think these will balance each other out. We're on track for the 5.1. I mean, going forward, I think in an environment where income's under pressure, clearly all banks, including ABN Amro, will need to look carefully at our operational effectiveness, and we'll be doing that coming out of the COVID crisis.
Clifford, I know the fourth quarter probably feels like a lifetime ago for all of us, but when we spoke to you last time, following the results, the market was a little disappointed in terms of the pushing back of giving dividend guidance. Recently, we learned that you won't pay an interim dividend in August as planned. And of course, the ECB and other authorities have been putting pressure on banks generally to scrap dividends. So with all that in mind, what kind of guidance can you give to the market on your dividend?
Yeah, look, you're quite right. The ECB has recommended to banks in Europe to not pay dividends through October the 1st this year. And in line with that, we've suspended dividends, and that's the news you've highlighted. We've actually retained the capital for our full year 19 dividend, which is around 600 million euros. So that amount is not in our capital numbers that I referred to earlier. And we stand ready to pay that no earlier than October the 1st this year, depending on where the regulator is at the time, but also where the economy and the bank is at the time. We've got a strong capital position. I mentioned the 17% Common Equity Tier 1 ratio, and we're looking to maintain the strength of our balance sheet to safeguard, our dividend paying capability as we come out of the crisis.
Thanks so much for joining us.
Very briefly, one market question. Sorry. Clifford, just one quick last question.
Yeah.
Nera and I are constantly trying to join the dots in terms of what happens in the real economy and what's happening in markets. Is there a disconnect for you, briefly?
Yeah, there's a lot of smart people trading markets. Clearly, things are challenging in the real economy, and you saw that on the front page of The Economist this week. I think what markets are taking comfort on is the extraordinary actions of the authorities globally, of central banks, of governments, to safeguard people's jobs, to safeguard businesses. And as ever, markets are looking ahead. They're not looking at today's challenges, but they're looking at tomorrow's recovery. And that's been underpinned by the sensible but extraordinary action you've seen from the authorities. And so they're looking ahead at the recovery following the difficulties of today. I think that's a smart thing to do. We're here as a bank with a strong balance sheet to support our clients, whether that's people or businesses, in order to bridge that gap between the challenges today and I think that recovery that will come in due course in the next little period.